Good morning, everyone, and welcome to another edition of the JBDC Virtual Biz Zone series. Thank you so much for joining us this morning as we continue our presentations. My name is Sansia, as you would already know. Well, at least for the persons who are always with us. And for those who aren't always with us, my name is Sansia. Good morning, welcome, and thank you for joining us. As you would already know, our JBDC Virtual Biz Zone series is a platform used to sensitize our client group on development in the MSME sector, especially as it relates to operating in the new normal. This morning, in particular, we are joined by business consultant Kevin Simmonds, who will speak to us on the topic the importance of numbers implementing proper financial and accounting system. And if you know, if you're in business, this is important. You have to have proper books, proper record keeping, so that you can do the right things when the time comes, or you can access the funding that is available, or anything else. And Kevin is going to tell you about all of that. So let me give you a little bit about Mr. Simmonds. He is the CEO of Dignity Financial Services and a business consultant with over 10 years experience in the fields of financial analysis, business development, systems and process design, and implementation. He's also a venture capitalist who invests in all small businesses with good ideas, but they're in need of capital injection. His academic qualifications include an MBA in economics and finance from the University of Edinburgh, ACCA training, in addition to certificates in investment and research and development. So he is well qualified to share with you this morning on the topic. Um, as always, you can feel free to drop your questions in the chat, or you can wait until after his presentation has been completed and he will answer any of your questions. So it's over to you, Mr. Simmonds, and we look forward to a fantastic presentation this morning.
Yeah. Hi, good morning, everyone. Thanks to the JBDC for the invitation to present on why numbers matter. Numbers are very important to not just business, but to our personal lives. But today we'll be focusing on why numbers matter in business. So, sorry about that, everyone is seeing the desktop?
Yes, Kevin, we're seeing it.
Okay. All right, so why numbers matter? So with relating to most of my clients will come in with great business ideas and lofty expectations. But what they lack after conversation with them is the business mindset. About the business mindset, or the business mindset separate the emotion from wanting to start a business to being realistic, to gauge the emotion and gauge the lofty expectations with what can actually be achieved. So after the presentation, I am hopeful that we will leave with the mindset and the understanding of why we need to apply numbers to most of the activities in our business and how that can help us to move the business from one stage to the next. And by that I mean how we can help the business to grow. So let's see what this looks like. One second. So what the numbers say currently. And this statistics is from the accountant taken from the ACCA website. So 4 out of 5 businesses they are saying fail because of poor cash flow management skills. And what this means is that sometimes we start our businesses and we don't have proper system to track the cash in and out of the business. And anybody who is successful in business will tell you that the cash is basically the blood of the business. So the cash determines, the cash you're able to retain in the business determine how healthy that business is. And so you want to be able to manage, to implement proper system in managing the amount of cash that is coming in and the amount of cash that is going out. And later on in the presentation, we will see why that is important. 8 out of 10 businesses start with no business plan or a poorly drafted business plan. A business plan is really a roadmap of so getting your business from the idea stage on paper and drafting a roadmap as to how you will achieve your goal of getting the product that you have in mind to get to your customer, how we do so with the aim of making a profit in the business. 8 out of 10 businesses do not price goods and services properly. I've seen this so many times when I'm consulting with clients. One of the biggest problem with this is that customers, when they get their invoices from their supplier, it's not recorded or filed in a way that makes it readily available for information that will help us into costing the product when we reach that stage. So if you are in the business of buying a finished product to sell back, it's an easier process, because what you'll do is just look at your invoice, add a markup to it, and sell it. But if you are in the business of producing for resale, then you need to record and file the invoices from your suppliers in a way that you can, 1, trace what it costs you to buy your raw material, and 2, the unit of measurement in that raw material. I remember consulting with a group of scientists. So they are excited about producing products. And my first day among the scientists, I was flabbergasted by what I saw. So they're good with developing and producing products, but the first day when I say, so what's the selling price for this product? Everyone looked at me as if I was talking some other language, because in the process of creating the product, no one was recording what the unit of measurement was for each of the items that goes into making the product, the finished product. And then what you have is an assumption afterwards as to what the selling price will be. And that selling price that they determine might not be enough to cover all the expense that goes into making in the product. And then over a period of time, of course, if your expenses are not being covered by your sales, your business is doomed to fail. So we want to avoid that. And later on in the presentation, we will see how we can put in measures to avoid all of that. 7 out of 10 businesses start with inflated expectations. We just touched on that a bit. So yeah, clients are excited about starting businesses, and that's good. And one of the things I always ask is, so who are you either buying this product to sell back to, or who do you want to produce this product for? And oftentimes I get the reply, everyone. And I'm saying, everyone? Needless to say, that is an inflated expectation, because I don't know of any business really that produce a product that can be sold to everyone. And what this conversation usually brings out to me is a need for a business plan. And business plan, as we will see later on, can help us to identify who our target customers are, how many of them exist, and how many of them we can realistically sell to. And that will gauge us as to how much we can actually get in sales revenue and also in profitability. 7 out of 10 businesses fail to recognize they're on the wrong path and need professional help. Again, it is great to have your idea. It is great to start your business. But I find that if you're a scientist, whilst you are equipped with a skill set of developing products and even creating products, you might not be equipped with a skill that is needed to properly trace the costing of developing that product, and also to implement system to trace the selling and the expense of the business, to later on separate those two and to identify why we are either making a loss, breaking even, or making a profit. And so what we need is someone who is comfortable with accounting and finance to offer guidance in this process. So why do we need to apply numbers to the vision, the idea of the business? Why do we need numbers? Why do we need to apply numbers to the plan, the design of the business? Why do we need to apply numbers to the creation of the business, the execution of the business plan? Why do we need numbers? Why do we need to apply numbers to the maintenance of the business operation itself? Why do we need to apply numbers to the growth of the business? After we have maintained it and now we are looking for opportunity to grow, how do we apply numbers to that process? And if needs be, how do we apply numbers to the reinvention of the business or the rebranding of the business to drive more value? So numbers and the vision, idea. Without vision, the people perish. So said Proverbs, and if Proverbs say it, it must be true. So numbers and the vision. So when we're thinking about starting our businesses, we start with some questions. Will I buy or will I be making this product? How many persons will I be able to sell my product to? How much of my product services will I have to sell to first make back my money, which is a break-even process, and also to make a profit? All these the answers to these questions lie in the plan, the design of the business. So now we're talking about moving the business from our minds to having it on paper as a guide to then eventually creating the business. So the design, the plan of the business. So if you fail to plan, you plan to fail. So said Benjamin Franklin, and if Benjamin Franklin said it, chances are it's true. So let us look at what that looks like. So you will not be able to, without numbers, you will not be able to create a realistic design or plan for your business. And without that plan, that guide, that roadmap, chances are you're starting out on the wrong foot from the get-go. And you are either on a course to failing or you have already failed. So in the planning stage, the design of the business, this is where we answer the questions that arise in the idea, vision stage. So now we know we'll be buying to resell, as well as we could determine, well, we're going to produce a product for selling. And whichever route we take, the idea here is to know what it will cost us if we choose to buy or if we decide that we're going to produce for selling. Also, what it will cost us to get our products and services to our clients or customers. And of course, this will include some amount of promotional and marketing costs. So this step will seek to give us a pretty good idea of what our total cost structure will be. The second thing we want to determine is how many persons will be designing, how many persons will be creating, will be either be buying the products to sell back to, or will be producing our products for, and at what price. And this stage is where we pay particular attention to the revenue that we are saying the business will generate. And we touch on how and the whole importance of how we develop a true selling price for the product or service that we might be offering. Because of course, that selling price will be a significant driver in our revenue, and also how we use our revenue to cover our costs, because of course we're in the business of making profit. The third stage is that we want to answer, is my revenue more than my cost? At which stage we'll be making a profit? Is my revenue the same as my cost? At which stage we'll be breaking even? Or is my revenue less than my cost? At which stage we'll be making a loss? At this stage, making a loss can be making a loss, the idea of loss in this stage is not necessarily a bad thing, because when we're starting our business, the initial startup costs will be high. So in the short term, usually in businesses, we will see where we are making a loss. But when we apply a forecast, which is step 4, where we show a spreadsheet showing our forecast, and what our forecast tries to do is to spread the costs, especially the initial cost of the business, that high initial cost, over a period, and also compare that against our revenue intake over a period. And what the forecast will show is that, yes, you might start out with a loss, but over time, you will generate enough revenue then that will take you to first the break-even stage, and then you'll start, say, a profit being realized. So number and the operation, the execution of the business. So now we're moving from the business being in our mind, the business being on paper, to now the business being a reality, a physical business, physical structure. And how we apply number to this is that we want to now track the day-to-day activities of the business. Regularly, when clients consult me to have a look at their business, after a problem, usually is when the problem already manifests itself, then I'll get a call to come and have a look. And most times, what I recognize is that some basic activities are ignored. For example, like filing of invoices, filing of invoices from our supplier for goods and service that we incur costs for. And so this stage is a very important stage of being able to track the day-to-day revenue generating activities of the business, and also the cost incurring activities of the business. So how do we track these? These are tracked by systems and processes. For example, a cash system will be a good system to track our invoicing. And what the cash system seeks to accomplish, we want to trace, or we want to manage the process of collecting cash to the cash actually that same cash that we collect reaching in our bank accounts, in our company bank accounts. And so we want to trace all the persons, or if we implement technology, involved in that process. So we want to look at things like who is responsible for collecting that cash, how we store that cash, whether in a cash register or otherwise, who have custody of the cash at certain points, who is responsible for checking off this cash at the end of our business day, and then who is responsible for writing up a lodgement slip to then have that cash taken to the bank. We also want to look at our stock management system. So we want to pay a keen attention to a very important item in our business, which is our stock. Our stock is basically the business itself. And so what we want to do here is to manage again the movement of stock into and out of our business. So whether it is we are buying goods to resell, finished goods to resell, or we are in the business of producing products for resale. The movement of raw material in the production process and the movement of finished goods to our storage area is very important. And then we want to also look at our logistical support system. And in a nutshell, and for simplicity, what the logistics support system does, it helps us to identify how we move our goods to our clients and the cost involved in that, whether it is we're going to pay a delivery truck to do it, a bearer, etc., and also the movement of items into the business from our supplier, whether that's a cost that will be incurred by us or the supplier. So system controls, what those look like, sales terms. So to manage our cash system, the question we want to ask here, when we make a sale, will that sale be on, in terms of, will that sale be on credit, or will that be a cash sale, or will there be a mixture of both in the business? So if we are selling goods on credit, the question we need to ask ourselves here is, how long, what will that credit term be like? How long can I afford for my money to be on the road? Can I afford for it to be on the road for 7 days, 14 days, 30 days? This is a critical decision that the business will make, because this lends into the working capital management of the business. And by working capital, we simply mean that the business is retaining enough cash in the business to take care of day-to-day operation, whether it is that we need to buy petrol for a delivery van, we might need to pay a weekly paid staff that we have in our business. And so we want to make sure that we design our credit terms to reflect the reality of the business, and we don't overextend ourselves when it comes to offering credit to our customers. Because one of the danger here is that you might find, as we will see later on, the implication here when we need to replenish our stock, which is basically to buy back stock for resale. If it's a cash only process we design, the consideration here is to determine how we will receive cash for our cash sales. So it could be something as simple, quote unquote simple, as making a transfer to the company's bank account and finding some ways, either you're going to take a snip of it and send to the business as confirmation that a payment was made, or it can be a written check, or it can be cash on delivery. Cash on delivery then leads to a further consideration of security, of how we secure the cash that we are collecting on delivery. Next, we want to monitor our stock. We want to monitor the movement of stock coming in, stock going out. And here we want to determine how will we, 1, receive our stock, 2, store our stock, and 3, pick our stock from our storage area when a sale or an invoice is generated. One of the most famous system that I know of is first in, first out. First in, first out helps you to, 1, make sure that the first set of items we have in our storage area is the first set of items that go out. What that does, it prevents us, it prevents one, spoilage, it prevents products from going obsolete. And of course, these will be additional costs to our business that we want to avoid. Ensuring that adequate funding is available for stock replenishment. So what this means, and this is a good balance between our cash system and our stock system. So here is where we realize whether or not we have a properly functioning credit system. Because if we have sold goods, and a critical area in the stock monitoring process too is to have a reorder level for stock. And this reorder level indicates to us that we need to replenish our stock in our storage area, because we are in danger of a stock out. And if when we reach that reorder level, but we do have funding to restock, to buy back, to reach out to our suppliers and say we need some stock and we're sending the money. If we do have that money available, then we need to really look at our credit term system and ask ourselves, am I managing my account receivable in an efficient manner? Am I collecting on time all the money that is out there for me to collect? Because this process can be a very costly process to the business, in that if you don't have the finances available, then you might have to borrow. And the cost of borrowing can be a very costly experience for some businesses. And if you have money on the road that needs to be collected, and for you are not collecting that money because of a poor account receivable management, then you are incurring unnecessary costs on the business, and over time incurring enough unnecessary costs for the business will sooner or later drive your business into failure, and you want to avoid that. So you want to manage these systems that were designed in an efficient manner. You also want to look at the costs, the costs involved in getting goods and services to your clients. Again, this is about transporting our products in an efficient way to our client, and we can do some cost benefit analysis and see which method is more favorable to the business, whether we are going to use a delivery van, or we're going to use a bearer, or some other means of getting our goods and services to our clients. Investment in customer service. This could be something as simple as monitoring customer sale, looking for opportunities to then call our customers and say, oh, hey, we know you're running low on supply. How many products you want to reorder? And in an effort to one, build relationship, and also to generate as much income opportunity for the business as possible. We also want to think of not just calling our customers to sell to them, but also to find out what their experience was like with the product and the service that we offer. And we want to attach a cost to this. For some businesses, it might be a one-person show, and they are doing all of this. For other businesses, it might be we hire someone to do both sales and customer service, or a mix. But whichever method we choose, there will be a cost attached to this, and we'll need to identify what that cost is. Numbers and maintaining the operation. So now that we have these systems in place, now we want to look at how these systems are behaving. So think of a car. You have a car. When you look at the dashboard, there are certain lights that come on, warning us that there's a pending problem, and a pending problem that will occur if we don't take remedial actions. So the maintenance of the operation will be looking to mitigate risk and inefficiencies in the business. So how do we do this? Analysis is always great. So now that the business is up and running, we want to look at our costs are performing, are they too high? And then look for ways to make them, to reduce costs a bit. We want to look at our sales, we want to compare our sales, and we can use parameters such as a daily sales rate, a weekly sales rate, monthly, annual. It just depends on which stage the business is in. And we want to look for certain variances, as to why we are not achieving the sales targets that we have. So after we identify these variances and we account for them, so identifying the variances, it could be we're not achieving our sales target because of internal issues. And we look at one of the internal issues on the previous slide. It could be that customers are sending in orders, but we don't have enough stock items to fill those orders. And that can be that we're not managing our accounts receivable process efficiently. And so we don't have, most of our money is on the road and we don't have the money in the business to buy stocks or to buy raw material to produce products, so we can have that available for sale when our customers demand for our products. It could also be a resource issue. It could be that we need to invest in some training because probably the labor that we have now is not adequately trained for the functions they are performing, and there could be some amount of inefficiency as a result. And we want to identify that. It could be remedied with a bit more training. And we want to design a plan to eliminate those variances, because if those variances are allowed, and I think one of the messages from ACCA points to this fact, that if you don't identify what you're doing wrong, that you need help early, you might be making the unintentional decision to guide your business to failure, and you don't want to do that. So once you identify these variances, you want to get somebody on board who can guide you with the proper financial and accounting skills to guide you as to how you can design a plan to eliminate these variances and then ensure the survival of your business. So setting sales targets. This is important because it gives you, again, like the business plan, it gives you a roadmap as to what the business can achieve. You might want to set some stretching targets, but not too stretching that it is outside the realms of reality and achievability. So you want to set realistic targets. And then you don't want to just set targets. You also want to design realistic plans to achieve those targets. So for example, if you know that right now you have 20 clients and average those 20 clients buy 40 of our products among them, you might can top that up a bit, because you might realize after your analysis that some clients can, based on their purchasing pattern, can really take some more products, because now the market the market know about your business, know about your products, word of mouth is spreading. And so you can, bump up. And when I say bump up, I mean like increase the sales intake of some of our clients, but it must be grounded in realistic numbers. And again, this is where the analysis comes in to inform us as to what can be achieved and what cannot be achieved. So we do have lofty, inflated expectations. And then we design plans that are targeted at achieving our sales targets, as well as we can look at costs. We can also reduce there might be some opportunity also to reduce some of the costs of our business. So numbers and growth, realizing opportunity for growth. So as mentioned on the previous slide, now that the business is in operation, we are doing our analysis to make sure that the business is fully healthy and there is no disease of high costs or poor system management. Now we can move into the phase of saying, okay, how do I now create the environment for my business to grow? What I want to do here, if your business is not growing, it's dying. So let's just get that right off the bat, because there is this thing called inflation that will affect our business. So whether or not we do anything, inflation is there, eroding our profit, eroding our revenue. So just with that in mind, we want to look for opportunities to increase our rate of sale, thereby increasing our sales revenue. And we also want to look at opportunities. So we can calculate, again, a reasonable percentage for revenue growth by sales increase. And we can look at, our relationship with certain clients, as well as we can invest in some salesperson to then go out and introduce our products to some new clients. And those are what we call growth generating activities. But we have to be careful here also, because it would make no sense that the cost of getting this new business is more than the cost of the new business itself. And so again, careful numbers, careful analysis, and reasonable numbers need to be applied to this process. Apart from revenue growth, to grow our business, there is also the opportunity for cost reduction. So if we are manufacturing products for resale, we can look at how the business is generating waste and then eliminate those occurrence of waste generating activity. And again, it could mean that our business is too labor intensive, and we might can add some technology to our business that will make it more efficient. So apart from new customers and cost reduction and increasing sales item, we can consider introducing new products. So one of my clients manufactures lotion, what they call cosmeceuticals. And the process of producing lotion is not that dissimilar from the process of creating a facial scrub. And so there was an opportunity here that was taken to then also introduce a facial scrub just from the process of making lotion. And actually, the new product, the facial scrub, was on par pretty quickly with the sales revenue generated from the sale of the lotion. So these are some of the things we can look at in terms of growing our business. Of course, new technology will no doubt allow us to produce our goods and services faster, and then also that will lend into the resale of our products at a faster rate, and a faster rate which will mean that we're generating income faster. And over time, what we used to make in a month, we're making in a week. And of course, if that process is allowed to continue, we can see how the revenue of the business will grow. We might also want to consider ways of working. We might realize that we are, doing certain things in the business might really need a mindset change. So we might can find areas where we can consolidate deliveries to customers. So during the maintenance phase of the business, we might realize that, hey, if we are sending products to Mr. Brown and Mr. White, it might be cost beneficial for us to put those together and just send out the delivery truck one time instead of us, and I've seen this happen, trying to deliver immediately as we get an order to someone, and then later on we get an order from someone else in the same vicinity, and then we're sending our delivery trucks or our bearer again to that location. That's not an efficient way of working, and our maintenance phase of the business should point that out to us, and we should, use the opportunity to, change our mindset and then be more efficient in how we go about the management of our business. So numbers and the reinvention, the rebranding. So this is where we start thinking about tweaking the business to a higher level. So the business is in operation. Everybody knows about the business. We have been going on for a while. The brand might get a bit boring, and we might want to think of ways how we can make the business exciting again. And one of the ways we can do that is to look at the cost for a new logo, and also how that logo will generate new interest in the business, how it will say to our potential clients, look at me now, right? As opposed to a logo that we have that, nobody would notice because it's not that exciting. We also need to look at who this logo will be speaking to, which demographic. And demographic, usually we also want to know their potential to spend, and also their ability to spend, because we don't want to be creating a logo for a demographic that we don't want to really have the money to buy our products, our services that we offer. So how much additional revenue can be added? Again, lends into the analysis of our numbers and also balancing costs and benefit. I recently worked with a client who felt that her brand was not exciting enough anymore, and she wanted to do a rebranding. And we find that after a month or two of the logo change, and then matching back against the target that we said we would achieve in terms of sales revenue, just by the logo change, we exceeded that target because the logo was a very exciting logo, and it drew additional people to the business, and that attraction then was commercialized and generated more income for the business. So these are some of the things that we can look at in terms of tweaking the business to a higher level. We can also look at how much value will a change in name add. So just like the logo change, how about a name change? Something that will generate attention. And again, this can have the same effect as a logo change. It's just a matter of identifying who we think that name change will attract more, and what the likelihood of them buying our product is, and also if they are equipped with the financial resources to buy our product. So is there opportunity to partner for a partnership? Again, with the example of the customer who produced cosmeceutical, an opportunity came up with someone who offered, slightly similar product. And what they did was to partner to then do a bulk production. And both of them sharing the cost for doing that. And they realized that by doing this, it reduced significantly the amount of money that each of them was spending in the production process. So these are some of the opportunities we can look at to one, reduce our costs. And if we reduce our costs, we know that that will translate into us increasing our profitability. So conclusion, numbers are important in starting the business. So as we have gone through, starting the business is, starting businesses is generally an exciting prospect, but we want to tailor starting the business. We want to temper it with proper financial planning, with proper numbers being attached to that idea that we have. And then when we start looking at the numbers, it will then temper our emotion and all that grand expectation that we have in starting our business. We want to take, mitigate the emotion a bit and get the advice of someone who is capable and have the skill set to say to us, great idea. Now let us see how we can make this a reality. Let us get into the process of designing a business plan. Numbers are important in getting funding for the business. Important here because our financial statements are very important. It should be important to us for sure, because our financial, and there are three main financial statements for most businesses. Your cash flow statement, your income and expenditure, your income statement, and your balance sheet. And all the activity of our businesses, all the activity will show up on one of these financial statements, if not all three. And so getting funding is a reflection of our financial statements. So we want to manage our activity and also the creation of our financial statements in a way that we are seeing internally a healthy business, which usually means that we are retaining enough cash in the business to fund our activities, fund our salaries, fund our buyback of raw material, or if it's a finished product for resale. And it's okay if we find ourselves not having, because we are in the growth stage and we are growing and we want to grow, it's okay if we don't have enough funding, adequate funding, but we still need to have proper financial statements, because then we'll go to the bank and other investors. That's what they will look at. And usually banks and certain investors, they know their numbers. So we can't hide, usually we can't hide a ailing company, a company that is not healthy, and an unhealthy company with the numbers, because most financial persons can make the connection between what is happening on our cash flow statement with what is happening on our income statement with what is happening on our balance sheet. And I've seen clients come to me saying that they went to the bank and they cannot, the bank or other providers of funding, and they cannot get the funding that they need. And when I look at the financial statement that they took to these people, I'm saying, but I wouldn't give you any funding either, because these are just not financial statements saying to me, invest in me, I will make you a return. These are financial statements that are saying to me, if you invest in me, you're going to lose your money. And of course, no sensible investor would want to do that. So it's very critical that we manage the activities in our business and have proper recording of what the numbers are saying those activities are either profit generating activities or cost generating activities, and at the end of the day, which one outweighs which. We would want to reflect a healthy business on our financial statements, and the only way we can do that is to manage our business in such a way that the revenue generating activities are more than, you know, the cost generating activities, at least over a period of time. So we want to, well, numbers are important, as we have shown, in maintaining the business, you know, doing periodic analysis, respecting what those analyses are saying to us, and taking the time out for remedial action. And this again lends into the quality of the numbers on our balance sheet or our financial statements. And so this process is critical. The maintenance of the business is critical, just like the maintenance of your car, because you don't want your car eventually fail you and leave you on the road. So you have to look at what the lights on your dashboard are saying to you, and then get professional help. For your car, it's a mechanic. For your business, it's an accountant or somebody with the financial skills to help you. One, probably move your business from an unhealthy position to a healthy position. So then you can take this to any providers of finance, and they can be happy to lend to your business or to invest in your business. So at this taking advantage of growth opportunities. So again, when we manage our numbers in such a way that we know what's happening in the business because we have been maintaining it, now we can think of increasing, you know, taking advantage of the fact that we can sell more, we can cut our costs, and all these are reflected in our numbers again. I cannot stress the importance of paying careful attention to our numbers, because not only our numbers help us to manage a healthy running business, it also helps us to identify opportunities to grow our business, whether it is that there is a new segment emerging that we can, you know, we can introduce our products to. And the analysis is showing us that, you know, there are some customers, because most businesses have a group of customers that they call their top customers, sometimes generating in excess of, you can have probably 5 or 6 customers who are generating probably more than 50% of the income earned by the business. And so you want to be looking for opportunities, one, in that segment of your business, that group of customers in your business, to then see what else you can sell to them and how much more you can sell to them. Also, you can look at the group below that. They might not be generating as much income as those top customers, but is there also opportunity to then sell to them some more that could also lead to revenue growth of the business, and revenue growth, of course, will then lead to the business growth. And as we just see, recognizing an opportunity for reinvention. Numbers are important into that process too. And so now we have looked at the business from the idea right down to having the plan, maintaining the business, the growth of the business, and even the reinvention of the business. But we have not really looked at any example of numbers in motion. So now this is a very simple example of some of the key financial statements, our cash flow statement, our income statement, and later on our balance sheet. And so what the cash flow statement really is, the cash flow statement manages the movement of cash in and out of the business. So, and it also controls the movement of cash between our income statement and our balance sheet. So the cash flow statement tracks our income generating activities and how that is growing or how that is reducing, and our outflow of cash and how we are managing that. So we see how that is growing or also how that is reducing. Either of those exercise will be saying to us, you're either generating too little cash or you're generating a lot of cash. So this is an example where we're showing the opening balance of our cash account. Of course, that is coming, our opening balance is usually the closing balance of the previous period. And it's also showing our sales at a particular period of time. And this is revenue coming in. So our total revenue at this stage is $170. And then it looks at what's the cost of selling those products. And in this example, we are seeing what it costs us to purchase, and it costs us $80. So our closing cash balance is $90. And then the income statement first record our sales revenue, and then the cost of that, what it cost us to sell those sale items, and then the profit generated from that activity. Our balance sheet show the closing balance of our cash. So the balance sheet. Oh, I should also give you what our income statement is. So our income statement manages all the revenue and expenses of the business. So all the revenue generating activity, that's recorded on our income statement, and all the cost incurring activity. By cost we mean expenses. Those are also recorded on our income statement. And the income statement should be telling us how our revenue, one, it records our revenue, and then it said to us how our revenue is increasing versus how our revenue is decreasing. And the same thing for expenses. It is saying to us where our expenses is at, what's happening with it, is it increasing, is it decreasing? And as usual, again, depending on what the situation is, we want to do an analysis to make sure that whatever is happening with our income statement, with our cash flow statement, with our balance sheet, it is in line with us maintaining a financially healthy business. Our balance sheet basically reflects what the business owns, and it seeks to examine if what the business owns is increasing or decreasing versus what the business owes to other people or investors, and also what we owe now, and is that what we owe is increasing or decreasing. I want to pay special attention here because we don't want to wake up one day and our business is totally owned by someone else. We want to be the owner of our business. And so it is very important here to manage what is happening with to know what is happening with your balance sheet, because we want to, so what is owned is usually termed as the assets of the business, and what is owed is usually termed the liability of the business. And at this stage, we want to make sure that our assets are what we own is more than what we are owing to others. Otherwise, of course, we'll wake up one day and we are no longer the owners of our business. Somebody else owns us. And we want to avoid that, because after having the idea of our business, the vision of our business, and gone through the process, sometimes the tedious process of operating the business, of all the trial and errors of the business, and sticking it out, year after year. We don't want to wake up one day and suddenly all that effort was in vain because we didn't manage, even though we were putting in all that effort. That effort was not matched by proper numbers to measure if those efforts that we're putting in were actually income generating efforts or cost generating efforts. And so we don't want to wake up one day with the disappointment that because we didn't manage our business in such a way that we apply the numbers, or we appreciate the importance of numbers in managing our business, that we have missed some signals that were sent to us. And by missing those signals, then we unintentionally hand over the business to someone else. So that's the end of the presentation. Again, this is some example of our financial statements. There's some description as to what those financial statements are, and there are some examples as to how these look in reality. So I hope I was able to impress upon all the listeners the importance of numbers in business, and also how we separate the mindset of wanting to start and operate in a business to actually having the business mindset. There's a stark difference. Wanting to operate a business is full of emotion and lofty thoughts and seeing nothing but sun on the horizon. But the business mindset will temper that and say to you, oh, just hold on a bit. Let us make sure that we are extracting every possible value from every dollar spent, and also that you're not moving around with your head in the clouds, and that you're actually level-headed and making sensible business decision. I'll share something that I read in the Gleaner yesterday, and it says it was an article on credit card woes, illiteracy fueling bankruptcy filings. And the article reads, 15 businesses and individuals filed for bankruptcy since the onset of the coronavirus pandemic last March, with runaway credit card arrears and financial illiteracy cited as overwhelming factors for personal debt through to the end of 2020. So the great business minds are able to read numbers like they read letters. They just know what to look for. They know how to read it. And so they can tell you when your business is on course to failing. And I think about mindset. Some of these persons who are unable to manage their credit cards because their credit card, they're always owing on their credit cards, they're incurring high interest rates on their credit cards. These are some of the same people who go into owning businesses, and they take that similar mindset into the business. And the problem with that is, if that is not remedied by somebody who has a skill set in financial to then help that person to change that mindset from the excitement of starting the business to actually having a business mindset, then sadly to say, that person will take that similar mindset of not being able to manage your credit card into the business, and they will not be able to manage the business. It's just a reality. So I don't really spend too much time in theories. I look on the ground on what is happening, and then tailor my advice to my clients based on reality, what is happening. Because at the end of the day, while theories are good at guiding us, sometimes they are not so good with the reality we are facing. And so I hope the reality that we will take away from this presentation is the importance of numbers in managing our business and preparing proper financial statements reflecting the reality of our business. And I hope the reality of our business presented on these financial statements will be saying, I am a healthy business. Investors invest in me. So I can then move from strength to strength, growing over time until we achieve whatever our goals are in achieving for our business. Thank you for listening. Now available for questions if there are any.
Mr. Simmonds, before I tell you how great the presentation, great and enlightening the presentation was in terms of highlighting the importance of numbers, I wanted to go back to something from you. You talked about waking up one morning and somebody else owning your business because you did something, you didn't do something right. How could something like that happen if you don't manage, for example, your balance sheet properly?
Well, your balance sheet, as I said, represent what you own and what you owe to others. So your creditors, depending on what category they are in, there are certain creditors of the business. For example, your preference shareholders, and these are people who are entitled to a set amount of interest on their investment in your business, whether you make a profit or not, and they have to be paid. So these, if your business is not generating enough income, right, then these investors in your business can then one day have more control over your business because, wherever, if you owe to the extent that you cannot pay, then your business, you can file for bankruptcy protection, one way, or there could be some agreement, especially where the preferential shareholders are concerned, to say then that no, we own your business, and they can actually, and it has happened, you can actually be forced out of the business that you started. It has happened a couple of times.
Has it ever happened in the Jamaican scenario?
I'll have to think back. I mean, in the early days of FinSoc, I know that Central Bank, but I think that was taken over by the government, really, and then sold off to a number of other institutions. I'll have to think back to that question to give you a...
All right, no problem. So I want everyone to know that we are now open for questions. So if you have questions, you can feel free to either raise your hand or drop it in the chat, and I will read it for Mr. Simmonds to respond for you. I see a hand, Chandris Foster. I'm gonna open your mic, Chandris, and you go ahead with your question.
Hello, good morning, everyone. Mr. Simmonds, just want to applaud that presentation. I feel like it's the missing
thank you.
business that I needed to know. I'm also gonna need your contact information for consultation purposes.
Oh, sorry, I should have bring that up.
Yes, so my question is, I am a startup venture. I'm the CEO of a small sole proprietor business called GV Cosmetics, right? So we initially would have started pitching the idea to investors, acquiring funding, and just testing the market in 2020 of last year, and really doing a business evaluation to see if the idea is even feasible. Now I've seen the idea to be feasible, and I'm looking to take the next step of laying the groundwork. For my question, when do you think is the actual time to start putting the numbers together? Is it in the startup phase? Is it when you have hit the market? And you acquired customers or, play by ear? Which one?
Well, I have a philosophy that I live by, which is do the right thing right the first time. So at source, and when I say at source, I mean at the start your business, you need to be getting the numbers right the first time, because this then eliminates the confusion that can come later on in your business when your activities, the rate of your activities, it's rapid, right? So you don't have time now to be starting systems, but you might have the time to be maintaining what you have already started. So it's always best to do the right thing right the first time. So get the numbers right the first time, and then you can build on that as time goes on.
All right. Thank you so much, Andres, for that question. You talked about systems that businesses can put in place to help to manage. I guess it would be the different kind of numbers that are required for operating the business. I know you were speaking specifically to managing working capital. Are there systems that are standard that, for example, our MSMEs can tap into, or is it something that they will have to design for themselves, for lack of a better word?
What I will say here, if I, I strongly believe that if you're starting a business, you should at least have the basic business ideas. And so I would recommend at first just feeling around with some spreadsheets to see
Okay.
in reality how these numbers affect each other and how your activity affect the numbers of the business, affect the profit, because every activity of a business is either generating an income or it is incurring a cost. And so you want to record each activity on a spreadsheet. And then later on, you can move from a spreadsheet to an accounting software. I always recommend ACPAC because ACPAC, from the generation of an invoice, ACPAC starts then thinking about generating reports.
Right.
So but first, it will be, you might not understand or appreciate ACPAC before you can appreciate how the numbers are represented on a spreadsheet and see the movement of those numbers.
Okay. All right, let me ask a question that just popped into my head. So, for example, if I came up with a business idea. Um, I'm a marketer, so my anything that I'm doing, the first thing I'm doing is from a marketing perspective. I'm testing the market to see what the customers want. If my product is something that has the capacity to be sold, if it's something that I can do efficiently and I can give it my best shot, and the customer group can benefit from it. So my first thing is not going to be to think about the numbers. How does an MSME that is just starting, how do they know what are the appropriate numbers to think about going into the startup of the business?
So what I hear coming out is the need for a business plan. Remember, we said that the business
Okay,
plan is a
okay,
guide. So your business plan should have all the activities from the idea really to the business being a physical business.
right, right.
And then what you will probably, not that the business plan will be perfect, but it gives you a guide and you can tweak the whatever is in that business plan as you go along. But it's always best to have a business plan than not to have a business plan. Not having a business plan will inevitably lead to confusion and a feeling of frustration. So you want that roadmap, which is your business plan.
And I understand the concept of the roadmap, but I also want to interject here as well that persons also need to understand that the business plan is a working document. So you don't just write it and put it down on the shelf.
Right, exactly.
Right. It is something that you keep tweaking as you go
Right,
along, because the business is not expected to stay static for the
right.
entire life of the business. All right. So there's a question in the chat from Max. In terms of making a note of the company's expenses, Do you also note personal expenses in this? For example, petrol, supermarket. Bear in mind that you do not pay a monthly salary to yourself.
Good question. And that was one of the points I should have brought up, that some of the businesses that I have worked with, some of the owners, there is no clear line as to what is personal money and what is business money. Everything is mixed up. The problem with that is,
Rolled up in one.
yeah, but the problem with that is you will never be able to track the true profitability of your business like that. So to answer the question, in finance accounting, there is a rule that we use, the 80-20 rule. So if you are using petrol to, if you're using your car for personal use, and also for, say, for example, use a car to drop off items to your customer, that is also a business use. And so you want to at least attribute 20% of that cost of maintaining your car, of fuel, and even if you're treating yourself as an employee, chances are you your lunch, whatever you buy for lunch, because if you were at home, you'd probably be having lunch at home. But because you're out doing business work, you have to then buy lunch in line of that. So 20% of that cost can also be attributable to the business. And this is important when you're filing your taxes, because then you want to, the money that you generate, all expenses related to the business can be relevant to your taxes and can be deducted. It can be it can be qualified for reducing your taxes because it is a business expense.
All right, fabulous. We're about to wrap up at this point because I know that there aren't many other questions coming in, and I've exhausted all the questions that I want to ask. So, Kevin, I want to thank you for joining us this morning. Your presentation was enlightening. I'm sure that everyone in this room has learned something new as it relates to numbers. And I would also ask if you could share the presentation itself with me. We usually post all our virtual biz zones on the JBDC YouTube page. So if there's anyone that you know who did not get the opportunity to join us this morning, they can always, I think by about Thursday, it should be up on the YouTube page. So they can always subscribe to our site, subscribe to our channel rather at JBDC Jamaica, and you'll be able to access this information. And of course, we use excerpts from the presentation just to highlight some of the high points. And there are so many high points in this. So Kevin, thank you so much for joining us this morning. Thank you everyone for joining us. A reminder that our JBDC offices remain open. You can always give us a call at 876-928-5161, goes up to 5. We'll transfer you to anyone that you need to speak to. If you can't give us a call, you can also send us an email at info@jbdc.net with your query, and we will pass it on to the relevant individual. As it relates to visiting our offices, we encourage you to give us a call or send us an email first, as well as we seek to protect ourselves as well as the members of the public from the coronavirus. So everybody stay safe. Remember, we have another session at 1. If you can join us, feel free to do so. You may also find the JBDC's YouTube link at our link tree. That's linktr.ee/JBDC Jamaica. And all of our links are under that link. So thank you again for joining us, and have a fantastic rest of the day.
Thank you. Thank you for having me, Sansi. I really appreciate the opportunity.
No problem. Thank you too, Kevin.